Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today I'm joined by Larry Berman, host of BNN's Berman's Call and co-founder and CIO of ETF Capital Management. As I always say, Larry is a pioneer in investment management as one of the first to adopt an ETF-focused approach in his tactical portfolios. So he's really seeing the value and efficiency of this vehicle. And today we'll be getting his thoughts on the market and some ETFs he thinks might be a good opportunity for the rest of this year. Before we get started, a quick reminder that we are not providing any investment advice or recommendations. Today is all about providing information and education around the markets and around ETFs for Canadian do-it-yourself investors. Welcome back to the show, Larry. It's nice to see you.
Yeah, good to see you too, Erin. It's 2025 is going to be an interesting year, to say the very least.
And you are spending most of it, I guess, in sunny Florida where you are today. He tells me he's going for a walk on the beach after this, so I'm a little bit jealous. But
it's good and bad. I've reached the stage in my life where I'm coming up quickly on 40 years in the investment industry. I'm going to have a big birthday coming up this year, and my bones aren't as warm as I'd like them to be this time of year. So fortunately, COVID proved the case where through the use of technology like this, Erin, we can be in meetings, we can operate just about anywhere in the world. So I'm pretty excited by technology, and I'm pretty excited that I can do this from a warmer place these days.
The best of both worlds. All right, so let's get into what we're seeing in the markets. We're obviously coming off a very strong year, a couple years in the markets with overall market performance, looking really attractive. Seems to sort of come to a halt over the past couple weeks, though. So walk us through what you see generally as the drivers of the strong returns over the last year or two, and what you think we can expect moving forward.
I read a book in 2024, and the title of it was Line Go Up, and it was a crypto related book, and I wanted to educate myself about what's going on in that space. I've actually read a couple books. I'm still quite skeptical on the whole thing, but I wanted to understand it better. We had back-to-back years of 20% plus returns in the U.S. equity markets. That's not the case for everywhere in the world, but the U.S. equity market has been exceptional. The leadership coming from technology. So the last time we saw this, and the last time indeed we saw back-to-back 20% plus years, was in the late 90s. And that was the dot-com and internet craze, and everybody who was a value tilt investor, kind of like me, didn't put up great numbers in that period, because we look for places in the world where there's better investment value, and we're not necessarily caught up in the flavor of the day or the emotion of the day. Having said that, the AI bump is real. It's going to add productivity globally across the board, much like the beginning of the internet did. But many of the stocks of the day in the late 90s don't exist today. And this time around, it's very, very different. But what we did observe is the leadership in coming out of AI and tech that's been really driving the markets. Since I guess Microsoft bought into ChatGPT, and we all know what that is today, has really been the catalyst for the move. And so that's really the backdrop. But the question I always ask is, what's normal? And if normal multiple on markets is 17, and we could argue that it should be higher than that, how much higher? Well, I don't think it should be 25. We could argue 20. So if earnings projected out this year and the following year, so 25 and 26, are projected to grow 10% a year, well, that gives us about $300 in S&P 5 earnings, Erin, for 2026. And at a 20 multiple, that's $6,000 for the S&P. So the markets are pricing in and discounting a lot of great earnings growth, and we may very well get that. Labor markets are strong in the U.S., but we are starting to grind a little bit and spin our wheels, recognizing that we've priced in an awful lot. So, in order to keep going, line go up, we need more good news to keep multiples expanding and growing. I'm not sure we're going to get that, but we're starting earnings period right now. And so far, the market likes what they've seen.
And we have another little bit of a curveball with Trump coming into office, I guess, on Monday. So how do you see this influencing the markets? What's your take on that?
Well, I think Trump 2.0 is going to be better than Trump 1.0. So let me start with that. Um, Many people who have followed me over the years on BNN knows I'm not a Trump fan. I don't like the style that he delivers what he says he's going to do. Having said that, I think the system has lots of issues. I think Washington is completely corrupt, politics in general. I think the way that Congress, Parliament in Canada have spent our tax dollars in recent years and decades, even has been terrible. And so I'm for smaller government. I love the idea of Doge, right? We've got the Department of Government Efficiency.
Mm-hmm.
Put up your hands, folks out there. Who wants more efficient government with our tax dollar? Like, is there anybody who doesn't want that?
No.
And so, is he going to be able to execute? There's not a lot of fiscal capacity, given that the U.S. economy at all-time highs in the stock market, basically with really robust growth, is already running a deficit of 6% of GDP. That number historically, Aaron, was reserved for recessions when the governments had to spend more money. So, you've got this momentum, but it's coming to a head soon. And I don't know what that's going to be. Aaron, if I could forecast markets perfectly, I'd have all the money in the world. And you would never see me telling people how to do that because it would be a secret. And there are no secrets in that sense. So I think he's gonna be better. I think there's a lot in his policy platform that's going to be helpful, but there's also a lot that's going to be a challenge. Tariffs are a big part of that. From the economic background that I have and everything I've observed in 40 years, that's not a plus for the markets. Many people
Yeah,
are arguing it is.
we've got that whole American first agenda with the tariffs, and talk to us a bit more about that, what you think the impact is going to be, and what from an investment perspective we can think about given this.
Yeah, when the government puts their hand somewhere, points their finger or pushes something, they influence, and there's unforeseen outcomes necessarily. For example, when the Fed started printing money with quantitative easing, well, that created a lot of liquidity. It boosted markets, so it got a desired effect. But what that did was help the people who already have money and gain wealth, and the bottom half with inflation coming in worse and worse and worse and worse. So that bifurcation is a problem. I think Trump is sincere that he wants to help the bottom half, but cutting taxes corporately isn't gonna do that, right? So the question is, how do you go about helping the masses and improving the overall economy? So tariffs will help domestic economies, will foster more job growth in the U.S. That might be an inflationary. Historically, tariffs have been seen and known to be well documented to be more inflationary than not. To what extent the market multiple doesn't like that, that's a big issue in front of us. So I would argue that headwind for sure argues for the stock market to consolidate, not necessarily collapse, not necessarily correct, not necessarily cause a recession, but to consolidate a lot of the gains that we've seen in the last couple of years. So sometimes a correction is down, sometimes a correction is sideways, and the economy and earnings can grow into that. That's more of a 2025 that I see, where the corrections are more limited to 10% ish off the top, not the 20 or 30 that would be an economic downturn. Now, if some of these policies turn out to cause that, if interest rates have to stay higher for longer, and that helps foster in a harder economic landing, that's a whole different scenario. I don't think that's the one in front of us, but it is definitely a concern.
Okay, and let's talk a little bit more about current valuations. I know you mentioned tech's key driver here, but given where we're at right now, and the sort of expectation for heightened volatility. Talk to us about some ETF related strategies that can help.
Yeah, I mean, valuation's high, but that's never been a good way to guide your portfolio because valuations, or as Alan Greenspan once said, markets can remain irrational far longer than you and I can remain solvent. And I think many other people have said that, in decades past. So it's a well-known thing that momentum can continue in markets. But as someone who looks at growth at a reasonable price or value, you would have argued that Europe's been cheap, parts of emerging markets have been cheap, and it's turned into a value trap because American exceptionalism and the great leadership companies in the S&P 500 have been driving and likely continue to do so. I wouldn't, say you got to divest of those. Question I would say is, well, why are you paying 35 times earnings for Microsoft
Mm-hmm.
if the long run number is in the mid to low 20s? So in the mid to low 20s, I love Microsoft, but here I got to question, how much of it do you own? Probably you still want a little bit. So an equal weight approach to the S&P 500 would be interesting. But I really like, in an America First agenda, that small and mid cap companies that would benefit by the U.S. doing better than other places in the world because of tariffs and change in regulation and making business easier, probably helps in that regard. So I like small and mid caps. I think BMO has a couple ETFs in that area
Yeah.
that could help. But really, with valuations, because that was your original question, the way they are, I love the buffer ETFs. We incorporate that into some of the strategies that we run for Bank of Montreal, into terms of trying to mitigate at least a normal course of volatility, so that, yes, high multiple, but you can still be there in case the markets
Yeah.
keep going up. So with these buffer ETFs, you still have some upside potential, but you have a decent part of downside risk, managed for you, embedded in the strategy. So a ZJAN, for example, that just rebalanced for January, looking out the next year, would probably be ideal for many people who want to stay in the game, but are worried about, valuation at the moment.
That's great. Yeah, I feel like I'm consistently hearing these themes of that broadening out, and small and mid caps is a good way to play that through ZSML or ZMid, our small and mid ETFs, and then playing it or protecting yourself in case of that downside over the next year or so with the buffer ETFs. That's great. Let's talk a little bit about inflation. You talked about tariffs. So I think mainly the consensus seems to be that Trump's policies around tariffs and taxes may be inflationary. So, how do you see the Fed responding? And again, what are some strategies investors can take to mitigate that risk?
So here's how fickle the markets are. So the recent US CPI data came in, and it was this much better than expected,
Yeah.
and the markets were up almost 2% in response. If it was this much worse than expected, the markets would have been down 1 or 2% in response. And so that's how sensitive the market is today to incremental information. Graham and Dodd fame. In the 1930s book on value investing, um, Graham said that in the short run, the market's a voting machine. In the long run, it's a weighing machine. And we see a lot of that now. And inflation is going to be, and jobs in the US, robust labor market. Those are going to be the two things that are really hyper focusing on markets. So, the volatility around key events like FOMC policy meetings, like inflation data, you're going to see more volatility on those days than you are on the average day. So that's going to be something that will pick up and escalate through 2025 and beyond as we grapple with valuations relative to where the market should be priced or ought to be priced in the long run, given fundamentals as we understand them.
So, is it buffers again in that sense, and managing your downside as the market reacts to these?
Yeah, it is there. And for the investors that want a little bit more sleep at night and not to worry about listen, if you have a catastrophic outcome, this is a major economic downturn. Small caps aren't going to help. Mid caps aren't going to help. They probably go down worse. But the buffer ETFs at least are going to mitigate a good chunk of the downside. But here's what I really like about them, because if inflation is the catalyst, your traditional balanced portfolio, your bond component isn't going to protect you. Inflation is really bad for bonds. We saw that in 2022 and 2021 and even into 2023 and a little bit last year as well, where bonds really didn't give you that risk mitigation that you hope for, where the buffer ETFs are guaranteed to do that because they're exactly protecting your asset. And in this case, the S&P 500, which is the biggest benchmark in the world. And part of my love for these kind of strategies is that it guarantees that protection. In a world of inflation, traditional balance may not do that. It probably won't.
And for our viewers who aren't aware, Larry does manage a few portfolios for us at BMO. ZZZD, our BMO Tactical Dividend Fund, is what we refer to as a sleep at night portfolio. So a good one to check out with some of Larry's best ideas as well. Any final thoughts around emerging trends that we should be watching as we head into 2025, or anything else that's on your mind?
It's hard to get outside of the AI focus today. One of the areas that have been absolutely decimated because the world has moved away from ESG is green energy. I do believe in climate change, what's happening now in LA area. A good friend of mine who's a professor at UCLA lost her home. I was emailing with her the other day. It's a tragedy. Whether that would have happened anyways, that's the debate. But I think the world in the long run is moving to green energy and clean and less reliant on burning carbon. I pitched the idea of an energy ETF that today has a lot of old energy in it and over time moves towards more new energy. I love that idea. So while I wouldn't exclude owning Suncor or Tourmaline, as a stock in a Canadian energy portfolio, I think over the next decade or two or three. And so that's an area that's super cheap right now. It was a terrible year. If you look at past performance, Aaron, you don't want to own that. No. But I look at things that are cheap that may have long-term catalysts. It could be another 4 years. We might have to wait for Trump 2.0 to leave before that green energy gets some love again. And so that is a risk. But I look at some of those longer term themes that are cheap right now on my radar. But it was disappointing last year to have some of that in the portfolio, to be sure.
That's an interesting idea about sort of the transition portfolio. It would be actively managed. Somebody would be talking to management about, where the best opportunities are. I like that idea. We'll take it back, Larry.
Yeah, the biggest investors in new green tech are the energy companies, because they know they want to be the energy companies of the future. And, they know, think about where the puck's going, not where it's been.
Absolutely. All right. Thank you so much. That was another great, insightful discussion. I always enjoy hearing your thoughts on the markets. So thanks for joining me. I hope you'll come back again soon.
Yeah, for sure, Aaron. Have a great 2025.
Next week, we'll be back and we'll be joined by our very own Bipin Rai, head of ETF Strategy, and Chris Kruger, managing director from TD Cowen's Washington Research Group, where we're going to dive even deeper into this hot topic that we touched on today of tariffs. So we'll talk more about tariffs next week. I hope you'll join us there. Then bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.